So, if you're like the majority of people, you save for retirement using a 401k, a 403b, or any number of taxable, qualified saving programs through your employer. What you don't know about your 401k is how much you'll lose in taxes and fees over your lifetime.
I learned so much about the abuse that happens to the average person. It's mind-boggling.
And you've specifically looked into the fees that people pay at 401ks and the fact that most people don't even know that they pay a fee.
This is the most amazing thing, that for 30 years, they didn't have to tell you what they were charging you. Only 3 years ago, the Department of Labor changed the rules and said you got to tell people what you charge them. Wow. So now they do that by giving you a 35 or 50-page disclosure document that if you have a PhD in finance, maybe you can figure out the hidden fees.
Yeah, good luck.
So here's what you have to know. Most people, 58% of the people, don't even think there are any fees. A 1% in fee, because of the compounding over time, costs you 10 years of retirement income. The average person thinks they're paying less than 1% or nothing, and they're paying 3.1%. That's 30 years of fees. So I'll give you an example. If you have a 35-year-old person, they have $100,000, and they put it in the market, and they let it compound for 30 years till they're going to retire, and they're paying 1% in fees, they have $761,000, which is nice growth from that time. But if you paid 3% in fees for the same stocks, you have $432,000. So in other words, you have 76% more money if you have less fees, or on the other view, you have 19 years less income.
Well, that was quite an interesting video, right? So now that you know that taxes and fees are going to reduce your retirement income, I'm going to start with a very quick and simple overview of this calculator. Now, I am going to show you the basic data we enter to do a side-by-side comparison. So, in this example, I'm going to use someone that's age 40. They're going to retire at age 65. And at age 66, they're going to start taking Social Security and start drawing money from their taxable 401k account. They said their current tax rate was just 22%. Then I showed them the U.S. debt clock and that the U.S. is over $34 trillion in debt and climbing. They guessed that taxes would easily go up to at least 28% and probably higher. And as far as fees go, most people don't know there are two sets of fees. You have mutual fund fees and you have 401k fees. Together they average a little over 4%, but to be conservative, we used just 2.5% in our estimate. Another consideration to think about is what kind of long-term rate of return you could expect. The S&P 500, the yellow line, including dividends, had a compound annual growth rate of 7.1% over the past 22 years, and the ChFC plan had a compound annual growth rate of 7.2% over the same time period. It's one thing to lose a bunch of money when the market crashes and you've got 20 or 30 years to go, but the market is always going to have market crashes, and you're always hoping to make up for the loss you suffered. But if it crashes when you've retired, and you're taking money from your 401k, it's devastating. I know you're wondering what the green line is, right? Well, it's called a TEFRA, or TEFRA for short, or a tax-free retirement account, is the long version. And I'll tell you more about it in a few minutes. Now, back to our example. This family is putting away $12,821 per year into their 401k. They also want to make sure they have income from their 401k to last until age 95. They don't think they could live on just their Social Security check, so it's vitally important to stretch their money out to at least 95. In order to make their income last until age 95, they can take out $21,484 per year to add to their Social Security income. What they didn't realize is that they would give away over $250,000 in taxes over their lifetime, and in addition, they also gave away over $412,000 in fees at just 2.5%. And if they did die at age 95, they would only pass along about $2,500 to their heirs. And if they were lucky enough to get an employer match of $2,000 per year, their income would only be about $24,600. Now, I'm going to introduce you to a program that was initiated by the U.S. Congress in the mid-1980s. They passed 3 congressional acts called TEFRA, DEFRA, and TAMRA, and these 3 acts became the backbone for this tax-free account. Plus, it's guaranteed to be tax-free under IRS Code 7702. After all, who wouldn't want tax-free income in retirement when taxes will probably be much higher in 20 or 30 years? This program allows the money that you save to grow tax-free, never lose money in a market crash, provides living benefits in case you can't work due to illness, and provides tax-free income until the day that you die. And let's not forget the tax-free death benefit to protect your family. The tax-free retirement plan is funded with after-tax money, and as you can see, $10,000 will be the annual payment. And we also set the age the income needs to last, to age 95. Most people think that if they are getting matching money, it's not worth it to give up the free matching money. But remember, that free money is also subject to taxes and fees. So let's see what the math says. The ChFC account would provide a tax-free death benefit of $218,000 at age 95. Not too bad as compared to your 401k, but more would be better, right? That's $693,000 of extra income. Remember, your 401k could only take home about half as much income in order to make your 401k last until age 95. They also saved over $340,000 in fees. Plus, they saved over $287,000 in taxes. And remember, the ChFC account is guaranteed to be tax-free, and your 401k is guaranteed to be taxed at any future rate. And I think we both agree, taxes will probably be much higher the closer you get to retirement. Even with matching money from an employer, the tax-free plan still wins by over $1.5 million. If you'd like a side-by-side analysis of your retirement options, then call the agent that sent you this video. Please remember this one point. They won't try to sell you or give you advice on which retirement plan would be the best retirement plan for you. But they will provide you with the mathematical information you need in order to make an educated, informed decision on how to have a truly diversified portfolio. And let's face it, that's exactly what you need. Information and education, right? Without seeing and understanding the math, your retirement plan is at risk of running out of money before you run out of time. But if you're serious about exploring your options right now and you're worried about future market crashes and runaway tax increases, then go ahead and book an appointment and see if a tax-free ChFC account is the missing component of a truly diversified portfolio. Like I said, we believe in education, not persuasion. Don't sit there and wonder if this ChFC account is right for you. Send an email or pick up the phone and call the agent that sent you this video and have them run a free comparative analysis for you and see how big your total advantage could be. And one more important thing to consider doing. Be sure to forward this video to your family, friends, and coworkers, and remember, every single person you know wants to retire someday, right? So share the video and share the knowledge with the people you know and care about.